let's start with talking about the Federal Open Market Committee's meeting this week. What do you think we're going to hear from them?
I think they're going to step back from this initiative they had about talking about when do we taper the purchases, how quickly do we taper it. I think they're going to recognize that the economy is weaker than what they had hoped and what is needed. And I think you're going to hear much more we're willing to step back in to do whatever it takes. So they're going to try and change the narrative away from the Fed is taking its foot off the accelerator to the Fed is maintaining its foot on the accelerator, and you know what? It could even press it harder.
Really? How likely is that?
I think that when you look at what's happening within the economy, a few things are clear. One is we are weakening yet again. And where we're not is because we're depending on artificial sources of growth. So the savings rate now is back to 2007 levels, right? So there's a recognition that the inherent momentum of the economy is still weak. And you don't want to taper off too quickly when that happens. And then the world is really complicated, right? You know, yes, we have a government in Italy, and that's great news. Yes, spreads are well behaved in Europe, but fundamentally, last week's data, including 27% unemployment in Spain, told you that the economic situation is not as good as what the markets would suggest.
So let's talk a little bit about, I know you're becoming increasingly vocal about the effects of the Fed easing. And in a recent piece, you said, it's official, the world needs to worry about the damage caused by QE. What do we need? What should we be most concerned about?
So what triggered that piece is that the G20, the collection of policymakers from around the world, recognized what Mr. Bernanke has been telling us for a while, which is that the benefits of the Fed come with costs and risks. And we've got to keep an eye on the costs and risks. What I worry about is when you run a system at artificial price levels, you start creating damage. Resources are misallocated. Too much risk is taken. The price signaling mechanism doesn't operate as well. And there's a limit to how. Now, it doesn't mean the Fed should do less. Critically, it means others should do more.
Meaning, what can they do to minimize the damage, and who are those others?
So those others are politicians in Washington, and in particular, Congress, Capitol Hill. I think everybody recognizes that we need to get this mix of less upfront fiscal contraction with medium-term fiscal reform. We need to do something about the functioning of the labor market. We risk having unemployed people become unemployable, especially the long-term unemployed.
How concerned are you, by the way, about that, the growing risk of creating a generation of the long-term unemployed?
I have a 9-year-old daughter, and every morning when I kiss her goodbye, I think of, is your generation going to be the last generation? I really worry about this because it speaks not just to the fact that we have unemployment, but our education reform is not moving as quickly as we'd like it to be. So I worry about it a great deal.
Let's talk about investors a little bit about, they have, as you say, suboptimal choices, and everything's at artificial levels. Are there any areas that are more or less inflated than others, and are you able to quantify the level of the inflation?
So you're wonderful because you're in Southern California. So let me use a Southern Californian analogy that Bill Gross came up with. Investors right now are surfing the wave of central bank liquidity, right? And they are pretty confident that that wave is going to go on for a long time, so they're not worried about having to kick out. They're not worried about what's going to come afterwards. A few things. First is recognize that this is a very crowded wave. Secondly, understand that if it doesn't hand off to genuine growth, there's going to be issues. And thirdly, look for opportunities where others are not. So there are many places that central bank liquidity does not touch, and yet there are attractive risk-adjusted opportunities.
And where would those be, for example?
So, for example, direct lending to medium and small-sized enterprises that depend on banks who are not lending. Secondly, we have some really exciting things happening in emerging economies where markets are developing and forming. Thirdly, look at the completion of markets. So there are lots of small opportunities, so don't put all your eggs in one basket called central banks. Understand that that is a risky proposition, and diversify, looking for other opportunities beyond a single theme.
Quick reaction to what's going on in Europe right now. There's clearly been a shift in the tone of the debate around austerity programs. Do you think that the shift in tone of the debate is going to lead to some meaningful change in action?
I hope so, but I'm not convinced it will. I hope so because Europe needs to recognize that growth is the major issue, and without growth, everything else that they're doing is not going to pay off. So that's the hope. Expectations, unfortunately, much less because you're talking about a number of governments that have a different interpretation of what has happened, let alone what should happen. So if you can't even agree on what has happened, it's very difficult. I think the reality of Europe is that the fire brigade, the Troika, is having difficulty coordinating. There's enormous creditor fatigue, there's debtor fatigue, and there are few growth models. So I think that the economic situation continues to be worrisome.